Hello traders, Nick Shaheen here, looking at insurance. Who needs it? How can we get it? Is it worth it? And all that jazz. Well, why am I doing this? Because the market just crashed. Yeah, I know. Nobody says it. They crashed. I started calling a crash a little bit ago when CNBC said, oh, it's orderly. Bullshit it is. It's not. Anyway, the VIX is 80-ish, whatever. The VXX is 80-ish, which is, I've never seen those two at the same level, again, at least not that I can remember. The VIX, I think, had a record close this or last week, over 80. It has hit higher than 80, but I don't think we ever close over 80. You can correct me on that one. Not the point here. The point is, if a stock owner, ticker owner, it could be a stock, index, a ticker owner, it's an investment. So is it worth to buy insurance or not? And what's the concept of it? How can I do it? So in order to buy insurance on stocks, the easiest way to do it is via the options. There's something called the put option. I'm not going to spend time trying to explain to you the jargon, theta, and all that bullcrap. I'm just going to speak it in plain, simple English from Main Street. I learned it on my own. I'm an engineer by schooling, so this I picked up on my own. They try to talk to fancy, but you can break it down to plain, simple English. The concept is easy. So this is a stock. It fell from the top about 27 or 25 or 30%. So it's too late to panic out of it for me. If I owned it here, bought it here, and I didn't get out all the way down to here, or after this bounce to here, then I really was ignoring the danger. This was the perfect time to buy insurance because technically that's drawing out the right-hand side of an inverse cup and handle. But that's not the point of this video. Now, the point of this video is that there could be more downside to go, and it could even go back to the $208. I'm not calling for it, but technically once it lost the 255, that's the target. So there is an important candle from October of 2019 that needs to hold, but it's a zone. This area right here needs to hold. Otherwise, this is very possible. Now, this is the point of control, which is where buyers and sellers are busiest. I'm going off topic. All right, so what is the insurance? So I'm going to take up a simple spreadsheet. Okay, so this is, let's say, Apple, the example, 100 shares. The cost is $246 per this quote here, and the extension cost, if I wanted to buy 100 shares, it's going to be almost 25 grand. Now, we all own cars, and if they're anywhere near 25 grand, I can guarantee you we're all paying insurance on it every month, and we don't cry that we didn't crash. Wasted the insurance. We didn't waste the insurance. We can't own the car without the insurance. So, is it a waste? No. So it's same with if I had a portfolio of $100,000, $1 million, 10,000, whatever the value is, if it's a lot of money for me, I should spend some money insuring it. What's the problem in doing it now? The problem in doing it now is it just got so expensive. It's like the whole block is on fire, and I'm calling my insurance agent, can I get fire insurance? Well, they're going to charge me up the wazoo for it. So in this case, how does it work? Let's assume it's not expensive. Let's assume we haven't corrected yet. So current price is this much. Let's say I'm comfortable losing all the way down to 220. So I go out there and I say, can anybody insure my 100 shares for 220? How can I do that? They'll say, sure, why don't you go buy one contract of a put option for Apple? And that guarantees your exit point for the 100 shares. If Apple falls below $220, you're out. Boom. Okay, perfect. So now I'm insured for X period of time. Now, they have contracts expiring every week. I can buy them out to next year. The further out I go, the more expensive they get. Makes sense, right? If I want insurance for 1 month or 1 year, I can't pay the same. Same with the car. Same with the health. Same with the house. I don't cry that I don't need insurance because I didn't need the surgery. Oh, I wasted my insurance premium. No, it's the right thing to do. So in this case, I don't want to insure my stock all the time. But if it's up at all-time level highs, at a record pace, why not spend on the way up or on the first couple of dips or on the first big bounce to buy insurance? It would have been literally 10 times cheaper than now. So, but that's hindsight. So in this case, I own 100 shares. I want to sell them at 220. I buy one contract that is for 100 shares. One contract covers 100 shares. If I own 1,000 shares, I'll buy 10 contracts. I'm out at 220 or lower. So if the stock is 220 and a penny, I can't go out and say, buy my stock, because it's not the contract. The contract stipulates below $220, I have the right to call it. Say, get me out. I exercise my right. So who's on the hook? Whoever sold me that put. It could be anybody. And I'll explain that on the opposite side later. So am I out and profitable at that point? Not profitable. Am I out at that point and breaking even? No. I'm going to break even lower. Why? Because I'm going to pay for that premium, correct? Let's assume that premium was $2. It's nowhere near $2 right now. It's 10 times worse. Let's assume it was $2 for the protection. Then, yes, I'm out at $220, but I'm really not benefiting from exercising my right until $218 or lower, right? Because I paid $2. Yeah, I'm out at $220, but it cost me $2. So it's going to be, I'm not going to get juice from it until later. It's like, whew, it went to $215. Great, I saved $3. That type of a deal. It went to $180. Sweet deal. You know what I mean? So this is the point where personal preference, how much pain can I take, is where I choose to buy it. I can buy it at $200. If I just want to cover the oh shit moment, then I pay less than $2. I'll pay 50 cents maybe under normal circumstances. Why is it? There we go. So then I just wanted to cover oh crap moment. If it falls to 100, then that was a sweet deal, right? If it doesn't fall through 200, hey, small price to pay for me to sleep tight. So this type of a deal. So what does it look like in real life? I'm going to show you today's snapshot, which is what? 3/18. Record-setting week. Maybe record-setting day. I don't know. Was the Dow down 2,000 points at the end? I forgot. It was down more than 2,000 points at one point. So I already was talking to somebody about it. All right, so let's clean it up. But the point is, this is what it looks like. This is an options chain and for Apple, and they have options expiring every month. I know it looks daunting, but it's a simple table. I chose to look at May, 58 days on the contract, maybe 57 after now. These numbers are enormous. They're usually like $2, you know, and they get more expensive. This is current price. This is where it is right now, 246 or whatever that price was. So this is where we're saying if it falls to 200, I want to be out at 220. Well, now if I want to buy the insurance after the VIX exploded from 14 to almost 100, so these are 10 times more expensive. So if my 10 times is correct, then this would have been $2 right here. Now I have to pay $20. What does that mean? It means that one contract is going to cost me $2,000 to insure 100 shares. So that's a pile of money. So now it's not a no-brainer. So that means I needed to go, the 200 or lower for it to make sense. So maybe I wait. Let's say it falls to 200 in the next week. I'm not calling for it. I'm saying, let's say it does. Then I don't have to exercise my right away. I can hold on. It's through 220. I can exercise my right at any point in time. Because if it falls another leg lower, then it totally makes sense. If it doesn't, then no. So this is the concept. Normally, this would be $2. Then it's okay. I'll pay $2 to sleep tight for 58 days through this whole mess. I definitely would. So if I had bought them before the VIX exploded this high, then I'd be sitting on profit. What you say? Yes, because whoever bought this for $2 now has $17 in profit. So $1,750 per contract in profit. So that's a pile of money. I know they lost on the stock, but that's profit they can book now and say, okay, I lost on the stock. I can offset my losses by $1,700, or I can hang on to the put because it's insurance. All depends. So buying insurance is never wrong. Almost never wrong. Buying insurance every week is wrong because then I'm over-insuring myself. But there are strategic places where I can say it makes sense to nibble on some insurance. This rally was insane. This crash is insane. Somewhere in the middle should have lied the truth, but it didn't happen. They rallied too far. So if I had ridden the rally all the way up, I would have either cut back, trimmed, locked, or sold calls, which is a different conversation, or bought puts or put spreads, if not here, if I missed this and it fell to here and like, oh man, it's too late, and it did this, here is the best place to buy insurance, because I saw the dip and now I have a potential bearish pattern coming up. What? Yes, this is like an inverse, actually it's a head and shoulders or an inverse cup and handle, that if they lose it, when they lost, not if, when they lost 255.5, this candle right here, it didn't hold. The fact that it didn't hold worries me, because technically it should fall to here, that zone, technically. Now there is this candle standing in the way. Feels like I'm repeating myself. October 2019, this is an important bottom. That's an important tail right there at, oh my God, today's low. 237, let's call it 238, today's low. But it's not a hard line in the sand because the VIX is so high. I can't claim a hard line in the sand. Under normal circumstances, this would be a clear buy place for me. It's definitely a nibble place, but there's no rush. This candle plays a role. So what is this one? 222. Let's call it 222. So 220 to 223. If the low from today fails, 220 to 223 should be the next place that it stops. This yellow line right here is the 1 year. This is daily, yeah? Okay, so this yellow line right here is the 1 year's most hotly contested line. Actually, it's a zone from 209 to 199, 200. It is where most of the buying and selling occurred. So here, the buyers are being overwhelmed by the sellers. When they get to this zone, both are going to be active like crazy, equals congestion, equals support. That's my interpretation. Now, the prices are still falling. The RSI is still holding inside of a pattern, not falling like this. So maybe there's some divergence occurring, like a bottoming in its strength relatively to itself. We don't know. We still have a few headlines out. Anyway, straying from the message. The message is, how can I buy insurance if, when, why, or what? I just showed you what it means to buy a put option. I'm basically covering, sorry, the chat room is open, 100 shares in insurance, and whether I buy it or not depends on my personal preference and how big of a gut do I have. Buying it now is, man, I really need a bearish outlook on the economy long term, because if Apple can't recover, that's the best company on the planet, then nothing can recover. So the idea is that I have to weigh the pros and cons of buying insurance on my asset. And when is it too far? So is there something in the middle? All right, I'm going to open up another subject and leave it here. So I don't have to buy insurance to where it's absolute insurance. Meaning, if I buy this, it's $2,000 out of my pocket for one contract. What if I can mitigate that cost, yet benefit from some downside? So I would buy a put spread. What does that mean? I pay $2,000 to open this one, the insurance, but I also sell this one. And I collect $1,400. So I'm only paying $6. But this gives me partial coverage because my maximum benefit, even if it goes to zero, is limited to the width of the spread minus what I paid. So the width of the spread meaning 220 to 200. So I can benefit $14 because I paid $6 worth of downside. So if it goes to zero, I'm winning. I'm going to gain on $14 of that spread, not the whole 20 because I paid up for it. That's just a concept. Debit, put spread. Kind of protection. The other thing I mentioned real quick, which is selling calls. So selling calls with the VIX so high, if they're covered calls, not naked calls, meaning I own 100 shares, I want to sell a call against them, there is no extra risk except me having to sell my shares at that level, then I can collect some money. How does that work? So you can see the numbers. So if I don't think Apple is going to go to 265 by May, I can sell that call and collect $2,200 for my 100 shares. So what does that mean? It means, I'm going to stop right here because the video is going to be a mile long. Anyway, that's called synthetic dividend. Hit me up. We'll do another one.